Good morning, everyone. CICT released its first half 2022 financial results this morning, and we are pleased to have you join us both in person and online via Zoom webinar. A warm welcome to all of you. On the panel this morning, we have Mr. Tony Tan, Chief Executive Officer of CICT Manager, Ms. Wong Mei Lian, Chief Financial Officer, Ms. Jacqueline Lee, Head of Investment, and I'm Mei Peng, Head of Investor Relations. We will start today's briefing with a presentation by Tony, our CEO, followed by a question and answer session. Please note that this session is recorded and will be uploaded on CICT website later. Now, may we have Tony share with us the highlights of CICT's results. Tony, please.
Thanks, Mei Peng. Good morning, everyone. Good morning, those online. Thank you for turning up today. I think it's a busy period for a lot of result reporting. Likewise, we have announced our result this morning. I think for many of you, you probably have heard me many times. I alluded before that this year our financial number will look very noisy, given that a couple of things we've done. We have development project that became completed. We have backfilled some of the space, but then there'll be a little bit of timing difference, and hence this year's result will be a very noisy result. Right? So this is a little bit of backdrop that I just want to emphasize. So let me zoom in quite quickly. I would probably not dwell too much time. I think probably based on what I hear in the chat, I'm sure you have a lot of burning questions beyond all these just published. These are easy to relate to, and obviously we try to answer as much query as possible. Right? So quite quickly, this first half result is of course it's a combination of things that we have done over the last 6 to 9 months. We look at some adjustment to our portfolio. We did some divestment last year with One George Street that was completed in December, and then we also sold JCube was completed in March. We went into a transaction to acquire 3 Australian assets in December last year. 2 of the assets was completed late first quarter, and the final one was only completed almost towards the end of June. So this gives you a little bit of backdrop, some of the noises that you come across in the number. At the same time, we have also completion of some of the projects, namely like 21 CQ that was completed last year, starting to see some contribution. Given that there will be a bit of a period where they are accorded rent-free, we will start to get some income coming from second quarter onwards. And then we have also completed Capital Spring. Completion was last year in November, and gradually we have been filling up the space quite nicely. Later you'll see in the slides. Today we are almost 100% filled, right? Just left 1 unit only. But then there'll be a bit of timing difference because when you hand over a tenant, that's where we start clocking the revenue. But then they will have fit out period where there will be revenue recognition, but then there'll be no corresponding rent payment until the fit out period is over. Right? So quite noisy number, but more substantively from a Capital Spring perspective, I think likely will come more meaningfully from second half and really more meaningfully substantively from 2023. Similarly, in Australia asset, we acquired and completed 2 of the assets in during the first half, but you only really see about 3 months or so of income coming in. We also completed the final one, Australia, only late June. So in fact, we have not even accounted for it for this first half, right? Because it's just too late. It was completed in 26 June. So it's kind of noisy. But nevertheless, they put that into context. I think overall our rental revenue has grown of 6.5%, I think. Yep. And NPI has also grown. But then translate to DPU, I think, of course, you see it's quite a marginal improvement from 0.8%. Overall, from operation number perspective, I think it's been very healthy. We've seen quite nice uplift, including a backfilling of space that's been vacated by some of the major tenants. Gradually we have a secure commitment. So portfolio-wise, it's gone up to about 93.8. That takes into account that those 3 newly acquired assets. Sorry, I didn't forget to mention. We also have taken in 79 Robinson Road, which is now renamed as Capital Sky. So it was only completed in April. So we see about two months or so of income contribution. So put it all together, the portfolio occupancy edged up a little bit to 93.8%, taking into account some of the assets that would require some time to ramp up, especially those newly acquired ones. From the retail perspective, I think we're seeing quite nice uplift. I think probably not surprise to many of you who have seen some of the other peers' result, retail result. Have seen quite nice uplift, particularly from second quarter onward, where the uplifting of the key measures, SMM measures, was lifted. I think that helps a lot. Downtown more, not surprisingly, outperformed suburban more, given partly because of the lower base, but also the fact that I think there's a little bit more pent up with the help of some tourists that trickling in. So we're seeing a nice uplift in the downtown mall. But nevertheless, urban mall also seen a little bit of uplift, given that now the dining option is being widened. There's more restriction in the mall. Traffic-wise, also seen a nice uplift as well. CQ AI we announced 2 days ago, and there's something shouldn't be new to all of you. I've been telling you that we need to do something about it. We want to de-risk this asset. It's been very heavy, focused on nightlife, heavy party, and somewhat associated to that kind of positioning. We think in the long run, to be more sustainable from rent perspective, we need to widen the trading hours, which is why we start to introduce trade that will bring in day crowd. At the same time, retain core element of Clarke Quay that's been important, has been also well-known worldwide, importantly well-known worldwide, and it will continue to be important attraction for tourists and people who want to have a good time at night as well. So we broadly zone into 3 areas. Riverfront, Warehouse, Circuit. Riverfront is a little bit focused on F&B. Circuit, high energy area, that's where people party. Zouk will stay there around that area location. And then the Warehouse is probably the main transformation. Currently, what I see are multiple shop units. We're going to rip a little bit apart. Internally, you'll see some nice skylight. Hopefully, that will be one major draw from people from all around the world, including Singapore as well. And it will fit in quite nicely. Hopefully, by the time the project Kennington Hill is completed in 2025-26, that will sort of bring in that full interface and integration nicely with a little bit of family, a little bit of the living family, but also element that's important for a nice lifestyle. So today we have reached about 70% of pre-commitment. Currently, we are about 70% each as well. And we have tenants that slowly will be easing out as the lease expire. But as and when they fit into the timing of the AI, will move them to the new location. So there'll be a little bit of adjustment going forward. The work will start in third quarter, in fact, in next month or so. So there'll be a little bit of adjustment from the occupancy perspective, and where existing tenant who potentially will stay on, but they may be relocated to other locations. Yeah. So stay tuned. Physically, you all are here, you can pop in, as and when is, I think you'll stay open throughout the 1 year or so of enhancement work. Doesn't move. Jam. Okay. Thanks. So Raffles City, I think most of the work is on track. We are progressively filling it up. The AI space, some new offerings, including Raffles City, Brunei. I think we are continue to bring in new exciting brand to reposition and strengthen the position of the 3 names here. But Raffles City, I think stay tuned, because we are entering to almost the final phase of the actual work. Progressively will be handing over to tenants. From a timing perspective, we hope to target majority of the tenants to be operational by 4th quarter period, which is where the high season for shopping. Yeah. And hopefully by then we see more influx of tourists coming to Raffles City as well. Yeah. So having said that, I mean, retail has been seeing a nice uplift given the general sentiment has been more positive than what you hear 12 months ago. We hope we continue to be able to bring new exciting brands, including new to market as well. So this is Raffles City I mentioned. You see quite a fair bit of brands here. This a little bit, I alluded before, we want to go a little bit a notch or two higher positioning wise. This representation of the different category, beauty, health, fashion across. We secure quite good names, and hopefully that will be the main anchor that will help to propel the leasing forward. Yeah. So let me touch a little bit on about the core flex strategy, which will replicate, I think, over time in our other properties as well. I think we tried experimented in Capital Spring, especially where we actually co-partner with TWP. So TWP is both a tenant with us. They occupy 1 full floor. They are also managing 2 floors for us. And we think that this is probably a potential going trend, especially many companies now are adopting core flex kind of arrangement, and be able to cater for peak and trough period where they may see changes in the demand for space. So TWP managed the 2 floors for us. I think the thing has taken on very well. So far, we have been very, very pleased. As of now, I think the space is high 90% filled already. And that sort of fit into that narrative that we talked about before. We have seen tenants that has actually secured tenancy with this building, but they need it immediately. But because of the construction work, we couldn't deliver the space in time. This flexi space comes in very handy. It's all within the same building, and it's like plug and play kind of arrangement. We are also going to potentially roll out. I know we are working through our 3 assets that we have been newly acquired in Australia to roll out such strategy. Space. We think such demand will pick pace. Many companies are very careful about how they look at their footprint and their space requirement. And naturally, I think cost management is important. That kind of flexible space, I think, would play an important role in their overall strategy. Yeah. So I think we'll start to look at it a little bit more in some of the overseas assets as well. Overall financial performance, I don't think I want to jump too much. MPI, I already talked about it already. Revenue stream very diversified, as you can see, but it's still going to be predominantly it's a good wide spread. Now you have suburban retail and downtown retail, as well as the office exposure. In overall, I think maybe a point out, because these are also a point of interest for many of you. OPEX naturally has gone up. Utility costs and hall costs going up. I've told you this year we hedged the rate all the way to the end. It's already more than 90% compared to the last rate that we pay. Albeit last rate we pay was really low rate because we really contracted when the market was really at the almost near bottom. So it's still a little bit uplift. So energy cost is something we manage actively to proactively through different ways. Obviously, consumption management is important. This is something that we do very actively. Looking at how we could even upgrade the efficiency of our own equipment. I think these are also things that are in the plan. We are also, and it's probably not new to you, and I mentioned before, that we're also looking at how potentially we can recover some of the costs through the service charge. It has to be building by building. It has to be substantiated. So we are going through the exercise, and hopefully we will be able to have some lending. Yeah. So take comfort that we're trying to manage this as actively as possible. At the same time, I think it warrants for us to relook at some of the costs that maybe potentially have to be passed on. Yeah. Balance sheet remained very healthy. NAV went up a little bit, 1 cent, 2.07, on the back of this substantially contributed from the divestment from JQ. Financing wise, I think this year more or less is all done, right? Maybe Mei-Lian can touch on a little bit more if you have some questions. We actually pushed out, if you recall, 2023, 2024, we have much higher tower. So we managed to push back some of the, well, not sure push back, we forward extension, some of the financing, 2023, 2024, further down the road, so that we have a little more tower that's a bit more manageable. Yeah. And that was, you probably see that from, as a result, the average loan duration also had extended. Just some snapshot, leverage gone up a little bit on the back of completion of some of the projects, some of the acquisition we've done, 40.6%. Hedge rate moved down a little bit, 81%, but 85%, we're moving down a little bit. I think we were fortunate we are in a position to do that because we started with a very high fix. Today, the market dynamic in the interest rate front has been very, very volatile. I think we need to have very active management on the interest rate side. And that accord us some flexibility in terms of protection because we started off with a very high fixed hedge rate. Yeah. Interest cover quite flat around there, 4.1, 4.2 there about. Average term maturity was extended further. So that's something I mentioned before. Overall, the average cost of debt edged up about 10 basis points. Yeah. So this I won't touch much. So portfolio occupancy 93.8%, edged up slightly from 93.6, I think. Yeah. But of course, it's a mixed bag. If we go down further down, Wales, I think I touched a little bit. Now let's extend it a bit. This one I won't touch much. Exposure, I don't do much. Okay. Later, I'll go on to the portfolio. So maybe I just come back to this one. So this is the mixed bag, 93 point, including the newly acquired one, where some of their assets are low. Also, exclude some leases were already in quite advanced negotiation, especially Capital Tower. We were looking at hopefully you can near that soon, or at least taking longer than expected for the final sign-off. But I think we are quite close to it. Let me zoom into retail. 96.5% occupancy. A marginal decline. I think it's quite flat. Last quarter we reported was 96.6%, I think. Yep, slightly lower. But then I think it's nothing to be alarmed of. Overall, I think the trading has been very healthy. We've seen a very nice uplift in the tenant sales, almost close to 16% for the first half. Stronger performance from the downtown uplift than the suburban, but suburban also track quite decent kind of uplift. Overall, you continue to see rental reversion narrowing down. We are, again, I mentioned we are progressively adjusting the rent, and you see the reversion is narrowing already. In fact, yes, marginally turned positive for downtown. Yeah. So this is the breakdown of all the different assets. You probably can see Clarke Quay is the main drag. And then of course some AI space within Raffles City, we took it out. If you look at it overall, if the Clarke Quay space is to be removed, we are looking at closer to 98.4% kind of occupancy. Yeah. Reversion, I touched a little bit earlier. There is continue to narrow down. If you were to compare the first quarter, we reported we've seen in fact second quarter is tracking quite nicely. Almost flat. Sorry, downtown mall is almost flat in the second quarter. Suburban mall is a higher 1.4%. Overall, we're looking at about 0.5% negative. Yeah, but I think we're narrowing. Yeah. Portfolio weight is up a little bit. Nothing to shout about. 2.1 year is manageable. Look at maybe the sales number. I did mention earlier, second quarter has been very strong. On the portfolio, in fact, portfolio we clocked 32%. On the back of course a lower last year, with a 50% improvement from downtown mall, and suburban we're seeing about close to 13% kind of that kind of range. Yeah. Not surprisingly, the trade that benefited the most during the period where there were heightened safe management measures in place that's been lifted up, those trade will see a little bit of reversal. So we see supermarket sales coming off a little bit. Home furnishing on the back of more people are being out back to the office again. So it's not surprising. And conversely, the trade has been suffered a lot more during the period, same period. Seeing a nice uplift, a bit bound. People start to shop again for their own, the clothing, the shoes, the bags. So the department store has been doing quite well, and not surprisingly, leisure, the club scene is getting very active again. You go downtown to Clarke Quay at night, you've seen the crowd has been pretty decent here. So now it's not surprising at all. On the office front, occupancy overall is 91.9%. Of course, this includes the Australia and the overseas asset particularly, right? But if you look at Singapore occupancy on its own, 92.9% is up from 92.3%. A little bit of detail here. If you could also notice, the main draft down is obviously the Capital Tower that we still looking to fulfill that. Including those space that I mentioned, we are almost nearing there. We're looking at potentially adding another 13% improvement in occupancy, hopefully in the next 1 or 2 quarters. Yeah. On the overseas side, German side, pretty stable. Australia, we just took over. A little bit decline in 66G Goulburn Street on the back of a non-renewal, but we have already begun to look at backfilling. But we also want to take the opportunity to upgrade some of the part of the assets, which is, we think, a little bit dated, especially the lift. Part of our acquisition plan was to really look at this asset and bring it up to a higher quality grade A building than it is today. So a few areas that we had planned in our investment from a CapEx perspective, we decided to bring forward, especially leases floor area that the tenants are vacating. We will bring it back and do a nice uplift. Yeah. We've seen some traction also in the 100 Arthur. We have filled up 6% or so, and we are also in discussion with a few other prospects. Hopefully, you can see improvement in the next few quarters. 101 Miller is a joint venture with Mirvac. We completed only in 26 June, so we are working through the plan. Potentially also may incorporate some of the strategy that we talk about in Capital Spring. Hopefully that will bring the quality of the tenant even further. This is one that I talk about a lot, no committed actual. It's a timing gap, so this is more for your own number projection. Progressively we'll be handing over space, and that's where I think the accounting will start, and then once the fit-out period is over, you see the cash flow coming in. This is something I mentioned earlier, so I don't talk too much on it. Wales, I won't talk too much. Expiry rent, safe to say, I think this year we're pleasantly surprised. I think some of the higher rent lease expiry area we are able to in fact crop positive reversion. So second quarter, in fact, all the property has achieved a positive reversion number. Yeah. So these are more for info. I won't delve too much. I think we also seen, it's probably not new to you guys as well. The hospitality trade scene is probably the major beneficiary in terms of this reopening and reopening theme, with the hotel rates going up quite aggressively. Occupancy also picking up quite nicely. Second half of the year will be a very busy calendar year for the social event. We at least get feedback from the hotel that the bookings are pretty robust. Weddings and conventions are all starting to come back, and of course you have the highlights like the F1. All these are, and then on National Day as well, it's been seeing a very nice, encouraging kind of uplift. And in fact, the RevPAR for the hotel is already surpassed $300, which is quite happy. We're quite happy for them, because we tried part of this period where we did a bit of a restructure in the rent with the hotel was to bring, like what we did for retail, bring down the fixed, increase our variable components. So we're enjoying a little bit of uplift from the variable component now. Yeah. Outlook, something I mentioned before, we have to be very agile and very proactive in managing our costs. Interest rate slide, of course, I think we may have our own view how interest rate will pan out. But we start off with a very good footing, and a very high fixed hedge position. We've seen the yield curve shifting all the time. As we speak today, you probably see some inversion already happened, probably deeper now. We will take advantage of that and act accordingly and try to minimize. I think overall the interest rate is expected to go up. To be fair, for the last 5 to 10 years, we've been enjoying a nice ride. We are able to get even a 10-year money for 2%. These days you can't get it. 10-year money all in, you'll be lucky to get maybe high threes, even maybe slightly around 4% all in. Yeah, but I think the era of ultra low interest rate, I think, is over. That's the reality. But we try to manage as much as possible. Overall, I think we should expect the average cost of debt to edge up. This quarter is about 10 basis points, but as and when we refi some of the expiring one, you will start to edge up as well. Okay, so I'll stop here, and we're happy to take questions. Our teams are here as well.
Thank you, Tony.
They'll help me.
Thank you, Tony. Before we start the Q&A session, I just some notes. So please note, for those of you who are present in this room, please raise your hand, and then we will hand the microphone over to you. Hold on, Mervyn, let me finish. And then for those joining us online, please type your questions in the Q&A box, and we will ask your question out for you. So yes, Mervyn, you can have the first question.
Yeah, Mervyn from JP Morgan. Maybe we can go to slide 34 in terms of the cash flow timing.
24, eh?
34. Yeah,
okay.
This one. Yeah, just try and maybe help us in terms of modeling. How do you see the actual occupancy hitting for these 3 buildings by end of third quarter and maybe fourth quarter? Yeah.
Okay.
And the cash flow and the cash flow impact. Yeah.
The first and the third one, probably very close to committed. Yeah, probably very close to committed. The 6 Battery Road, we have a couple of deals that we are looking at. At the same time, we are also progressively taking back space to upgrade to the latest fire code. I mean, this is a agreement we had with the SCDF, as and when the major expiry, we need to basically do the catching up with the latest fire code requirement. So there will be a bit of timing difference. We hope by end of the year, we are aging closer to 90, maybe low 90%.
Yeah, sorry, just confirm the Asia and Capital Spring get close to committed by year end.
Yeah, hopefully by close to
third quarter or end of third quarter, how do you see that? Is it halfway between or?
Probably closer to fourth quarter.
Closer to the fourth quarter, because of fade out and rent free. Yeah. Okay. Maybe turn to the retail tenant sales. Maybe give us some sense of how does it compare to pre-COVID and the occupancy costs, to give us a sense of how hard you can drive the rents going forward.
Okay, occupancy cost been healthy in the overall as a portfolio is about 17, around 70%. So I think we are in a very healthy range. Compared to pre-COVID, suburban is higher naturally. I think we're looking at about 5%, thereabout, higher than pre-COVID as an overall basket of retail, suburban retail. As a basket of downtown, we're slightly down at about 5%-ish down, lower than pre-COVID.
So I guess third quarter downtown could get close to pre-COVID, I presume.
Hope so, yeah.
Hope so. Okay. All right, I'll leave to other people to ask questions.
Thank you, Marvin. Jen.
Hi, this is Tan Xuan here. Just one question on sizable acquisitions. I mean, given where gearing is.
Yeah.
Just one question on sizable acquisitions. Given where gearing is, how are you going to balance between making the acquisition accretive and also maintaining healthy balance sheet?
Yeah. So there's no magical bullet. I mean, the honest truth is we have to look at different options, right? When we and it's no different from any kind of transaction we've done. You know, we've done different combination from a simple debt finance to a combination of debt and equity, and then also obviously also debt equity with a little bit of recycling of capital, and finally also looking at partner, right? So I think we have done different form of combination. I think we just have to explore what's the best way to do it, and it's all about timing, right? You know, whether talk about, let's say, equity partner, whether the timing fits nicely, you know. So it's all about all these variable that you can't control at the point in time when you look at any specific opportunity. But we've done all this before, so we will explore the best way to do it.
Can I follow up? What's the max limit of gearing you're willing to go in this cycle?
I think we mentioned many times 40 plus minus around there is something very manageable. Given the fact that I think, of course, we've been driving the asset performance over time, asset value will help cover part of it. We're also cognizant of the fact that the interest rate is also rising, so we want to strike the right balance. But 40% is something we feel is very manageable. There about plus minus. Ideally, you give yourself a little bit more bandwidth in terms of headroom if you want to seize the opportunity very opportunistically, right? Then a lower gear will definitely help for you to react faster. But nevertheless, I think we will manage accordingly.
Yes.
Nicholas.
Nicholas.
Hi, Nicholas from Credit Suisse. Just want to ask in terms of, I guess when you look at the portfolio and potential divestments, which are the assets that would be on the periphery of non-core that you could possibly look at, or even you've already kind of started receiving more interest on? And then the other question I had was just on TWP, you talked about 6 Barry Road and Capita Spring. Just want to understand how the economics work for that. I guess they are operating the space for you. You'd have to pay them some fees. Yeah, just any details you have on how the income works there.
Sure. So first questions in the we naturally, I think, look at the opportunity. I think we also concurrently will look at our portfolio construct. I think it's a journey. I think I mentioned before, it's a journey. Sometimes it's about when will be the right moment to do it. You have at the back of your mind, okay, something that potentially, if there are other alternatives, then we can react. Otherwise, there's no hard reason, unless it's so compelling that somebody gave you a mind-blowing kind of thing. There's no way we are going to run the asset to that kind of extent, right? Then that would be a moment that we may consider seriously. Yeah. So, but nevertheless, it may also trigger sometimes when you look at investment opportunity that surface and define is so interesting, and perhaps we look at within our portfolio, this will be a potentially better deployment of capital than current one we're holding. Then there may be another trigger point. But safe to say, overall as a REIT, I think we position ourselves quite clearly. I think it is the function of the REIT is really invest in the long run, in long-term income generating assets, right? I mean, that's the mandate we have, and that's something all the different authority looking at us to fulfill the role, from MAS, from MOF, from IRAS, right? We have to be very careful. We are not in the business of doing trading. We cannot be seen as doing the business of trading. So this gives a little bit of context. Naturally, what kind of candidate will be potentially over time, we feel that it wouldn't fit so well. It's about timing, right? Think that we feel that maybe we can't really max out anymore. We can't scale up because there are limitation, regulatory limitation. That could be one candidate. Other candidate would be things that doesn't fit into our mandate, geography wise. But then is it the right time? You see, if it's not, does it is that compelling enough for you to act now? If it's not, then we're happy with it until the time is right. Yeah, then we can do it. Yeah. So these are January 2 area. We constantly try to see we could further bring more productivity and value into any specific asset, whether it's through a very simple AI or into a very extensive kind of redevelopment possibility. And eventually, if we come to the analysis that such possibility is not fulfillable, then potentially it could be a candidate as well. Give you a little bit of context.
Then on the TWP economics.
Yeah. So by and large, there will be a bit of performance incentive driven. We do have a kind of base fee that we pay. Normally it's not a lot, but we incentivize to performance side. So there will be certain target for them to achieve. Beyond that, we have a profit share. That's more or less about the kind of arrangement. Yeah.
Okay, how much space are they going to take up?
2 floors. I don't have 2 floors in Capital Spring. I think 6 battery. Look, we're looking at 1 floor as well. Yeah.
Yeah, thank you, Nicholas. Okay, we'll go to Rachel first. Rachel.
Hey, good morning, Tony and team. Thanks for the briefing. Just a few questions from me. I think for a start, on the office front, what's your outlook on reversions? I see that your expiring rents are also creeping up. How strong is the office market for you to push the rents?
So, good question. I mean, this is something that we also ask ourselves, right? I think overall the momentum has been decent given the context of what you hear around the world, right? Companies are also starting to do right sizing, right? But overall, Singapore still stands pretty good shape in general. The supply situation is not overbearing, so you have a little bit of supply advantage. And in the context of whether demand is going to pick up aggressively, in the context, I think that one a lot of people wait and see. But new setup coming to Singapore, I think will be interesting. That's something we'll track closely given what's going on around the world. I think this is a quite a natural one, good location to be in. Some sector you already hear in the media, it's reported by different analysts, family offices. I mean, they are all aggressively trying to come here. Right? So those are occupied here and there spotty. But big company, I think then be very careful, especially you're talking about whether you want to uproot or it's just a adjustment. So we have seen some adjustment. We are not hearing a major uproot. There's some pockets of uprooting, but not major. But they are adjusting to cater for business that make more sense in this part of the world, to be anchored themselves in. Yeah. So I think in that context, I think demand will still be fairly reasonable. As in where the rent threshold it will be, I think it's a question of industry with industry. Overall, you see the inflation it's all going up. We are talking about service charge potentially will also be going up. So in the context of everything, I think we have to be mindful. At the end, we are entering a period where globally the expectation of a slowdown in growth. So that's really the backdrop, right, that we have to bear in mind as well.
Okay. Do you think rental reversions would remain at high single digits for the rest of the year?
For us, I think we had a few low-hanging fruit which we captured, right, first quarter. So it's sort of anchor that in. The remaining of the year, the leases expiring are decent around slightly below market rate. I think we'll be okay. I think should be okay. Next year, if you look at the slides you have, next year, we started to engage some of the key tenants, right? Next year overall, the expiring rent average is also not demanding. I think it will be okay. Whether it will be a high kind of a reversion, I don't have the crystal ball, and I can only say that what you hear from the consultant, some of them are projecting very, very strong, nice number, and a little bit more conservative. Generally, a bit more conservative. I feel that there will still be ongoing kind of adjustment, right sizing, some expansion, but then there'll be company will still want the right size because they are adopting flexible work arrangement, right? Then even if you have more and more demand coming in, you also will see how this right sizing, kind of dynamics play out. So there will be a bit of market that it's probably not reported anywhere, but we call the sublet market, the gray market, that we'll pay attention to as well. Yeah.
Okay, my next question is on what do you think of the MacArthur's portfolio?
Huh?
MacArthur's portfolio, the assets in the MacArthur's portfolio.
Well, I don't
It's
know what people
interesting.
speak on our behalf. If I mention we are not looking at it, nobody will believe, right? It means in our home yard, a backyard, own backyard. We treat it as one of those pipelines. We look at it. Is something we are familiar with. The space we are familiar with. We have the skill. I think we will naturally be interested to take a look at it.
Do you like the assets?
There are some pluses and minuses overall. I won't talk about too much. I mean, it's still in the process, right? So, I would say there are some interesting elements within the portfolio, yeah. But some that okay.
Got it. Thanks.
Okay. Sorry, because there's a question from the webcast. It's quite linked to just now what Rachel asked about office. So I think following that, one of the question asked was, and do we see any trade sectors seeing attrition from office space, if any? Because I think just now we talked about the leasing demand.
I think you hear a lot already in the general news media. Some big tech company, crypto market has been going through crypto winter, right? So I think that one is washed out a little bit. But these are not big space occupier. We don't have big. In fact, we hardly had any exposure on the crypto space, so we are okay. Big tech company will be adjusting. The narrative we hear now is that they probably have reached quite at a point where they are okay. Those that already announced, then the space that they need to expand, it will probably be enough for a couple of years. But again, the business landscape may change, operating environment may change. We're talking about recession, but then how quick the recession, how short recession, it may be a quick turnaround. In fact, I'm already talking about slowing down the rate hike. Market already projecting potentially even a rate cut, right? So all these things are very difficult to project in the next few years. Right? It's just too volatile now to have any kind of projection. This part of the world, we are somewhat sheltered. Hopefully the China element will play out nicely. Now, hope that they will be embarking on the route of recovery. And then I think this part of the world, especially Southeast Asia, nation where a lot of intra-Asia trading will benefit a lot. That will give a nice uplift in terms of the sentiment. And that's where I think the demand may pick up in maybe 1 or 2 years down the road. I don't know. Yeah. So very hard to project how that will pan out. So supply is critically important. So supply situation in a way is pretty decent. Some of the older stock will come back to the market, been taken out from redevelopment. ASA Tower, the one at the Shandon Way, 77 Rock Shandon, what is that one? 78. A few other smaller one, in fact, small asset, but then reasonable size. So Beach Road, a few will be coming out. Goku Midtown will be completing. And then we have the Beach Roads, the Shaw Tower will also be completing. So there'll be new supply that were taken up previously, they will be reintroduced to the market. So there'll be a bit of competition, I would say. Of course, there are different sub-markets. And it all depends on over time how that demand will stack up, coming from what sector that will be growing. Right? So and the demand in this various sector will change over time. Over the last 5-10 years, we've seen a nice boom in the overall the tech sector. It's been gobbling up space, right? Which will be potentially the one, or maybe they continue to grow. Who knows? Yeah. So supply situation, I would say generally been quite supportive for the market. And the market rent now, I don't think has risen to the point where it becomes a big problem for Singapore. Right? So I think we still overall would not be deemed as a very expensive place to place your business center. But that's the space I'm sure the government watch quite closely. And if they have to act, that means new supply will come to the market. And that's where competition will start again.
Sorry, we'll go to Vijay first, followed by Brandon and then YK. Sorry, thanks.
Hi, morning, Tony. I have a couple of questions. My first question is on the overseas portfolio. In terms of Australian market, the market seems to be a bit soft in terms of occupancy ramp up. Maybe can you give a bit of color in terms of physical occupancies? And I remember there was some rental support for some of the projects. When is it until, and what's your outlook? And also in terms of German market, with what's happening in terms of German European economy, as well as the exiting of anchor tenant, what's your thoughts on the market? And does these two market remains your overseas expansion plans?
Wait, I cannot turn the page. Sorry. Just go to the slide on the portfolio
photos.
occupancy.
Portfolio occupancy. Tony, you will manage.
Oh yeah, yeah.
You will manage.
So the three Australia set, I don't think it's any surprise for us from the occupancy perspective. We more or less expected it. One by one, I can address it. 100 Arthur, we know the asset is good quality. 70% of the space are fully referred. There's some remaining space are occupied. And during the down period, the previous owner has done a major upgrade. So our job, make sure we do the leasing up. When the market turn up, hopefully we are ready for that. And the market demand dynamic is also shifting a little bit to like what I mentioned earlier. The flexi component become increasingly important for the occupier in Australia. So from an 100 Arthur perspective, as and when those currently occupied space that will be out for renewal, we will spend some capex to finish up the whole work, right? But overall, it's beautiful, right? So we hope that leasing will traditionally Australia leasing market becomes very active closer to late third quarter, fourth quarter. I mean, that's where their summer period is. Yeah, I think that's traditionally the high demand period. So we are watching carefully. So we want to put the asset in a ready position, including 66 Goulburn Street. So 66 Goulburn Street is a southern part of the CBD. It's an area that will go through multi-year generation because of the focus on the New South Wales government. I think they have not been benefiting from the tech run. I mean, Australia generally, there is no major big tech company that's been there. So they want to create that precinct that will shape the landscape in the southern part of the CBD. So it will take years. Yeah. So 66 Goulburn is a decent grade A asset. Relative to the price we pay, I think it's a good price. When we look at this asset, we knew the few things we have to do. It's a question of when we do it. Right. Now we took it over, and it coincides with some tenant who decide not to renew. We think that it's timing for us to fast track the upgrade the building, especially the particular floor, and more importantly, I think to position it to ready for the higher leasing period. We want to upgrade the lift hall, the lift, the ambience, the sense of welcoming and arrival is not up to par. It's something that we were planning for in the next 12 to 18 months. Yeah. Back to 100 Arthur, I think when you look at it, this was two asset that was negotiated with that previous vendor as a package, and we knew that we would take some time to lease out 100 Arthur. That's why we got the rental kind of support that is enough for the next 18 months. Yeah. They will be able to run us through. 101 Miller is a joint venture, so it's a different dynamic. We don't have full 100% control. We jointly own the asset, so it will be a jointly managed asset. So both of us are Mirvac, as you probably know, they are respectable player in the market. We'll collaborate with them and we work out a strategy to bring the asset to the next level. But to begin with, it's a premium level asset at North Sydney location. In fact, it's probably the most strategically located asset, sit on top of the transport network. So you can't replace that. Location-wise, 101 Miller is really probably it's not the best location in North Sydney. So we are okay. Location-wise, once you get the location right, 80-90% are better. The rest is about whether you're fulfilling the needs of the occupier and the incoming occupier. The German market is kind of a market is kind of in a stage of, I think, uncertainty. On the one hand, without the war, I think it's been ramping up very nicely. You see, if you go to Frankfurt, it's busy, right? With the onset of war and the implication on energy price, and then the implication on the wider economy that Germany may take on a hit, it becomes a little bit careful. So market is going through a bit of a wait and see. So at the moment, nobody is doing anything. It's relatively a quiet market, watch and see market. We have two assets. One is in the airport location. So very much driven by the activity and the airport location, which is picking up. So to be fair, you read a lot of news now in Europe, like travel is being picked up very strongly and to the point where they can't even cope. Right? So the aviation industry has been strong. The airport location generally will thrive when you see high traffic start to come back again. So it's been quite stable. In fact, we have our occupancy is creeping up, but in the long run, that location, the airport location, we have to see we're positioning, whether it's the right positioning. Galileo, which is the one in the banking district, super prime, right? So it's within the CBD. So CBD is a big widespread area, right? Within the CBD, banking district is the prime of the prime minister. So location-wise, can't run away. Right? So the question is how we're going to fulfill the needs once Commerce Bank vacate in January. So we are looking at different options, which I mentioned before. It could be a multi-let option or it could be a single-let option. Both options are possible. Implication, multi-let, longer downtime, because a lot more work, common area, and all this is going to fix up, right? Potentially also longer downtime from a cash flow point of view, because you can't expect everyone to move in the day one. Right? You will be a staggered kind of movement. So that's a multi-let. But of course, in a long run, multi-let scenario would probably give you a little bit lower risk, single tenant risk. Single-let scenario, which is also possible, there are prospects, much shorter kind of downtime from a construction work point of view. CapEx-wise, potentially may not deviate too far from, it's lower, probably lower than a multi-let, but will not deviate too far. But the cash flow will come in quite immediately. Yeah. So we are exploring both options. German-wide, I think no different from Australia, any overseas market. We need to create a meaningful presence there. Two assets is not meaningful at all. So we'll see whether there are any opportunity. Given the very uncertain market environment, we see how the market movement over there, whether there will be any adjustment to cap rate. Historically, very hard to compete. We can never be competitive against the local funds. And in a zero, in fact, negative interest rate environment, you have a lot of speculative kind of development and redevelopment. Hopefully that will stop. Right? And that will change the whole dynamic. So we'll watch. But we're keen to expand, but we also know that if after some time we can't get a meaningful presence there, then we may exit it altogether. Yeah. We'll see how it goes from there.
Thank you, Vijay. Thank you, Tony. Brendan?
Oh, thanks. Tony, just three questions, right? The first one, with regards to your overall acquisition strategy, given the current environment, will you be prepared to take on DPU dilutive acquisitions at the outset? and then with some rental growth, aim to improve that subsequently? That's my first one.
I don't think my answer will be any different in any time. It all depends on the underlying asset you're looking at. I mean, it's so different, right? We went into Australia, we got a good deal. I think the price was good. Give us that runway for us to ride through. So we can't be saying whether on the day one we should be looking at a dilutive equity, because it all depends on, first of all, when you do a ideal scenario, you have enough time to do your full duty, including your asset plan day one. Sometimes you don't have the kind of time to look at it. So you have to do make a judgment. Is this opportunity quite obviously certain area we can claim now? Then potentially it will not be dilutive. Right? But sometimes we know that we see something that over time we know that we can fix it. Then question is how much time we need and how much CapEx required. Then we start to plan, CapEx, do we want to fund it upfront today or fund it much later down the road? Then that's where I think the potential accretion dilution becomes story. So I don't think I can give you a simple general statement whether the dilutive kind of environment will be. It's all about how you're able to roll up your roadmap. What is going to look like in the next 2 to 3 years, and what are your plans? In the ideal situation, we have enough time to deep dive, we get our team in to do a full asset plan. Yeah, that would be great. But in many cases, you won't have the luxury to do it. Yeah, especially the party.
Okay, the next one will be on your service charge, right? For the retail properties, are you able to just increase the service charge like the office ones? Are there clauses inside?
I mean, we can increase. Of course, you just have to make sure you are able to justify your increase. Your cost has gone up. But what's the impact, right? So you probably know the fair tenancy agreement, the code of conduct that was entered into. It will be legislated, but we have voluntarily adopted it. Means that existing contract is for tenant is indifferent. They are completely indifferent. You pay $10, you save 150 service charge, 850 is a rent. If service charge goes to 170, you still pay $10. So existing contract, no change. Then question is on the renewal. When you get renewal or bring in a new one, do you want to be upfront right there today? Yeah, we're not increasing the rent. Overall, it's still 850, but service charge 170. Right? So that's how you approach it, right? Realistically, we have to look at the market sentiment, market condition. It's a question of whether we had the pricing power to do it in the context of the general economic situation, the employment situation, the consumption strength, the consumer sentiment. I think these are all important things to consider. We may end up in a situation where we cannot pass in full through the adjustment to the rent. As much as we can, we try to, right? And tenant likewise are also through their own mechanism of passing on to the consumer. So it's all related, right? Consumer are prepared to pay a higher price for whatever product they're so it means all is about demand supply. So it's a thing that's all intertwined together. You cannot look at it in isolation. But safe to say, in a good economic environment, yeah, we can go ahead and do it. No problem.
Okay.
Hi, you came from CLSA. I have one question on pricing of acquisitions, because previously you sold JQ at sub-4 yield, right? And when you look at today's market, it seems that tenant sales for suburban malls is picking up above pre-COVID levels. And so my question is, do you think, is it fair to say that you will not pay anything below 4%? And you also mentioned that funding cost is inching closer to 3-4%. So how do we balance that?
Yeah, our cost of capital is definitely more than 4%. So a blended basis, definitely more than 4%. So sub-4, it will be diluted. Honest. Then question is, Brandon mentioned.
Yeah.
Would that be? So I don't think I want to generalize with a broad stroke statement that anything sub-4 you can do. it can be sub 4 for maybe an occupancy at 70%. Right. So it has to be on a case by case. Yeah,
But
then
4
it's-
to 4.5% looks palatable, you think?
It's the same answer. Case by case, right? Yeah. Some deal 4.5% is not doable because you may start in a very high rent, high occupancy, no upside, we only see downside. Right. So you have to look at case by case.
But this is a bundle deal, right? It's not like a buffet where you can.
Whether it's bundle deal or single asset deal, I mean, it has to be on the same principle. Where are we able to drive value coming in? It's not day one, down the road. We have to have a clear idea.
Okay, I have 2 more questions. One is on Clarke Quay, the 68 million. What's the ROI? 62 million. What's the ROI on that?
ROI, I would say in the mid-single digit.
Mid-single digit. Okay.
But we have to be careful how we define ROI. So we are spending quite a fair bit of money. Actually, if we don't do that, this asset is at high risk, right? I think we announced 34% of it really to make sure that we fulfill our obligation as a good citizen. Green CapEx, upgrading chiller system over time will improve the efficiency, upgrading the comfort level so that over time the asset becomes more. Because I read quite a fair bit of commentary in some forums and say, "Wow, so hot," which is precisely what we're trying to address the issue.
No, but after spending this amount, is it will you just be able to bring the occupancy back to 100%, but passing rents will
Naturally,
be
that's
like
our goal.
similar to
Naturally, that's our goal to
Yeah.
gain 100%. Yeah.
no, but passing rents would it be higher as well?
Over time, yes, it may not be there.
Last question is on the service charge. Do you have an idea how much of your portfolio on the retail side you can actually pass through? Like you can actually confident of saying that you can pass through the
as you see,
service charge.
contract I already touched upon is under the code of conduct, we can touch it. So the whatever balance, when it's renewal or new leases coming in, I think we can translate in the form of whether a service charge or higher rent. So it depends on how you look at it. Because in the tenant's mind, today I pay $10, $8.50, $1.50. Let's say I say, oh, sorry, now it costs us $1.70 to operate the mall, right? Because everything else gone down. They say, sorry, I'm not only pay $10 existing contract. When come renewal, I say it's $1.70, but you still pay $50, $1.70, $10.30. Or in a very strong market environment, it can even double, right? Instead of $1.50, it'll be $9 plus $1.70. So we will be very tactful on how we want to approach this. And it will be a case by case. Strong performing tenants. Now we are doing a lot of, in fact, our GTO rent is going quite nicely, range from high is close to 15%, I mean, in the portfolio, to a low about 5%. So, and it's all to some extent tied to how we structure the rent. Yeah. So I think the overall, what is more important is to look at the tenant specific, the sales, the threshold, where the occupancy cost ratio. Then you determine what's the best way to position with the service charge in the back of your mind. Yeah.
Okay, Derek.
Hi, Tony. Derek, DBS.
Yeah.
Just one question. I'm just looking at the McArthur's portfolio, which have been a lot of people asking a question here. So in terms of funding rise, right? If let's say you would like to acquire and let's say you would like to take a partial stake, could we assume that you have also third-party capital behind you in this particular acquisition, if it
We
happens?
can't comment because it's still in the process. We just can't comment. Yeah. That's why I say a lot of people are speaking on behalf. But we are looking at it. I think it was really important. Yeah, we can just acknowledge that we are. And earlier I mentioned some okay, some not okay. So right.
Okay, sorry, just because it's related, let me just ask this question. I think it's also about the just not what we've discussed, but I think more broadly, this person would like to, Simon would like to know what is our comfort level with our current portfolio asset composition? So because I think this question also talk about the Mercator's portfolio and all, but it's more how we want to look at, are we comfortable with the current asset composition? I mean, because if we buy more retail, then it'll be more heavily on retail or as such.
Yeah. So this question will have different answer at different point in time. Right. Which is why this whole thing about a more balanced portfolio, diversified, giving the leeway to adjust when market conditions change. Right? I mean, we have blood in our stream, the retail and office, this in us now as a portfolio, right? So we wouldn't say we want to avoid anything specific. What we do like is a product that has got a more on its own a defensive mechanism. This is more a mixed use integrated where naturally the component will self-enforce each other. We think in the long run, such asset will be more resilient than a standalone. It can withstand the test of time. It may not be the best outperformer in any sector run, but I think it will be a long run, a more stable and more resilient asset that will be fit into the portfolio of a REIT. So in general, I don't think we want to cut that nice funding. I think when we did the merger, it so happened it's quite close, right? About almost 1/3 each. And after 2 years fast track, when we acquire the office portfolio, now it's gone a little bit after the completion. But then that's because now office cycle seems to be the favorite, but things may change over time. Yeah. So I don't think we are very agnostic about how, we're quite agnostic about how things will shape out over time. We only know that the answer will be different today, maybe 3 or 5 years down the road, may be different.
Yeah.
But generally, I think a more integrated defensive asset on its own will be something more desirable. And which is something that we are looking at even overseas. And overseas also picking up this trend. We are beginning to see more component. Of course, they have different market, different kind of component. We've seen that like rental market, part and parcel rental market and office coexist with retail. Singapore is not rental market is not popular other than the service department, right? But you begin to notice this trend is already taking shape in many markets. Even in Australia, single asset purpose owner are trying to diversify away by bringing new element to their assets. And in the context where especially they have sufficient land plot where they can carve out, they are able to do it. So we've seen the trend that they're really picking up, whether it's Australia, UK, it's happening.
I think Gulam, this question.
Thanks. Yeah, sorry. Hi, Gula here from the Edge. I have a couple of these general questions. How diversified do you want to be? Because you've seen Link REIT go into logistics and all that sort of thing. And CLCT, it seems to be selling away all its malls one by one. So are you going to stay like 1/3 mixed, 1/3 retail and 1/3 office? So that's one question. The second one is, there's a lot of focus on this greening of the portfolio and everyone's talking about ESG, but how does this benefit your investors? Because they're the ones you have to turn to for capital if you want to expand. So that's the two general questions. One more. Okay, there used to be a lot of concern about e-commerce, but this morning we've not had a single question. So I'm just wondering whether there is still a focus, et cetera, on this e-commerce being a threat to your properties. And the last one is a specific one on, on the balance sheet, because the SGX, I mean, this does not apply to CICT, but the SGX has asked some of these Chinese REITs, because they have a lot more long-term debt compared to their short-term assets, because it affects the liquidity ratios. And I think CICT has around 1.1 billion of shorter term debt. I think it expires within 1 year. If you look at the financial statement, I think they're all MTNs. So I just wondered, what is the market like for this part of the debt of, demand for this kind of debt? what your plans are on that.
I'm
So-
busy noting down in case I forget a question.
Yeah, so the
Four,
the
right?
first one is, yeah, four
Yes,
questions.
four questions.
First one is very general about,
How
diversifying.
diversified.
Second
For
one,
the moment,
green. I don't forget.
We have pitched ourselves as the main commercial player. Singapore is still if you anyone or we have been telling investors that it's no different pre-merger, post-merger. If you want to look at commercial space in Singapore, we should be the platform to look at because you have that diversified base. So commercial, so commercial define office, retail. It can be a little bit other component within the integrated, but generally I think it's the two larger components will still be retail and commercial. So that answers your question. ESG, I don't think we can ignore that completely. Although there's a lot of discussion how that benefit, and of course there are even wider discussion on fund specific, they are ESG focused, right? And I mean there's a lot of sidetrack discussion whether they are excessively charging investors because they didn't them as the premium guy, and then ultimately the number didn't stack out, they underperformed the general broad market. In fact, the non-ESG stocks that you want outperforming. So I mean these are in the context, but I don't think we can run away from the fact that this trend will continue to be critically important because it's all about resilience of your portfolio at the end, right? Yes, investor may have a shorter time horizon, 3, 6 months, 9 months, 1 year, for them to them is financial performance key, right? So you ask many investors, they think they'll naturally say, yeah, we consider all things, but financial performance still has to be number one. It means they are not prepared to accept a lower return, given the fact that their investors are. So it's like the supply chain. They are not expecting a lower return because their investors are also not expecting a lower return. But I think the dynamic is shifting already at the ultimate end of where the source of money is coming in, whether it's people, general people who put money in the mutual funds, and then the mutual fund investor look at who can manage the money, right? They are starting to do. So it's a process. It's just that over the last few years, COP27, I mean, these are all big picture, and country are taking that position and setting the tone, because otherwise nothing will move. Right? So the country are all setting the tone, including Singapore setting the tone. Right? So I don't think we can run away. And one glaring example that, in fact, we may even want to heighten our move is look at the cost of energy. The cost of energy, 12 months ago, we were stretching our head how to buy green energy, renewable energy. It costs X% the premium. Today, the delta is so narrow. In fact, at some point in time, it's even cheaper to lock yourself into a green energy. So I think the dynamics will change over time. So I don't think we can run away. I mean, that's only the E, right? Of course, the S and G will be very important. In the context today, I think S is still going to be very important. And companies talk about it, right? They talk about it, and they actually are executing it. Flexible work arrangement actually is really to fulfill a big part of the S element of the employee. So, but how that to translate to dollar and cents, I cannot put a number to it. I can only say that we want the product to be resilient so that your end occupier think that this is a place you want to be, because they also fulfill the G. Because it could be very binary, whether you are considered as a location or you are not. It could be as binary as that. Right? And then within the bucket of, they will consider the bucket, are you in the front runner or you're at the back? But as and when this momentum takes place, more and more demand and end user will require that. And I think that's where the dynamic on the economic dynamic will shift. Today, honestly speaking, we all go around asking tenant, hey, we have all these, we are all these index, green, satisfy or sustainable. Are you going to pay 20% more? Is it? No, they think very hard, right? They're very, very hard. Yeah, but they're beginning, there are some who are prepared to do it. Regardless, I say, no, we have to fulfill our own. So there will be a growing list of end occupier eventually. Yeah. And when it comes to the financial institution, I mean, they're also being pressured by the regulator, right, to move into green financing. Hopefully, we see a lot more savings from cost of borrowing. Today, marginal, you're talking about few basis points. I mean, these days the market move 10-20 pips in half an hour, right? Look at the bond market, can move 10-20 pips in 1 hour. So 2-3 basis points is nothing. So, but I think things will take place over time. Yeah. So very long-winded answer. Yes, it's important. We cannot ignore that. It's a question of how over time we'll do it. We started to plan about our capex over time, green capex. Long term, precisely to take in mind that we know that this financial return is still going to be important. We cannot be so blindly going to say all our building going to upgrade, best in class chiller system when it's only about maybe 6-7 years old. That doesn't make economic sense. Yeah, then that's where the kind of decision will come in, where economic and logic and your practicality and sanity will check that coming, and we have to make the judgment. But we are starting to plan in the next 5 to 10 years. Line out property by property, which are the ones due. Then just prioritize those that we think is a little bit more urgent than others.
The last question is about the
e-commerce.
Yeah.
Surprisingly, you're right. I don't know why nobody asked me. So you just track. Maybe it's very more transparent now. In Singapore context, the Department of Statistics report the online sales number has been trending down, right? As market reopen, I don't think it's surprising at all. Where you at land today, we're about 12%. I have no answer. I knew that when things reopen, you see I think I mentioned many times, you see a spike up, but once reopen, you see the share will come back down again. It may hover around there, this level. Whether you go back to 7-8%, I don't think so. I think once habit is kicking, you're quite comfortable from a security point of view and from a comfort and ease of transaction point of view to transact online. I think that would be the game. It's how about retailer, how they play this game, how they position themselves in the context of consumer who are quite agnostic maybe about whether they should buy online or offline. Maybe they want to buy online because they think it's always cheaper, but not necessarily always so, right? But some may prefer to buy online after seeing offline. So then offline become important. Then question is, retailer would say, hey, my offline, should it be in what kind of location? Is it important to be a good location? I think this kind of strategy will come in.
Sorry, her last question. It's about the
balance sheet.
MTN market.
The interest rate.
The short-term liability reclass into, this quarter is due to like what you pointed out, 2023 maturities. So we do have a fair bit of bonds, about 870 million, due next year. Yeah. So in terms of refinancing option, as what Tony has mentioned, we do have available committed facilities on hand in excess of 1 billion that we could use to refinance these maturities over the next 12 months. Right now, we're still observing the bond market. On and off, we do have reverse inquiries. It's a matter of whether, what investor want and what we want match. So they may want, like much longer tenor than what we want. So it's more a matter of pricing and tenor, what we are looking for. Depends on the tenor again. Yeah, so for the same tenor, we're looking at, say, a midpoint of 5 years. So investors can look at a longer tenor, like 10 years or even more longer. So for us, if we are comparing the banks market based on a 5-year tenor, I would say that at this point, the bonds market may require slightly more credit spread because of the volatility in interest rates.
Okay, I will just repeat the question that Gula asked, because I think because without microphone, they may not have heard. I think Gula was asking any difference in the rates between facilities and MTN. Yeah. Wilson, you want to go ahead?
Hi, morning, Wilson from Morgan Stanley. Just a few short housekeeping questions. Can you remind us when 21 Collar Key rental contributions coming in?
When does the 21 Collar Key rental starts?
Starts
And
already.
when it started already?
Okay.
Yeah.
And on utility costs, they increased quite a bit for the first half. How much further increase do you see in the second half?
So second half we'll see a little bit more than the first half, because first half we had the benefit of half that was hedged was extended from the old contract for 3 months. So we enjoyed a little bit lower rate. On a blended basis, I mentioned we are about 90% for the whole year, about 90% higher than compared to last year. So second half we'll probably see today we see about 4.4%. I think this same store, not talking about new asset that comes in. Could potentially creep up be about 5%, I think. It all depends on consumption, right? So we are trying to manage consumption.
Can I just ask a couple of questions from the webinar? So there's one question about what is the hedge duration for fixed debt and what is the cost of new 3-year Singapore debt today?
The average hedge duration is about 3.5 years. Current rates for 3-year, referring to bank loans?
Yes.
I think in terms of all in, we're probably looking at closer to like slightly below 3. Below 3, between 2.5 to 3.
Okay, yes, Joel.
Hi, this is Joel from DBS. I have 3 questions. The first one, could you share your percentage of GRI contributed by gross turnover? And my second question is regarding the gross turnover. I understand like 5 to 14% on a more basis is like GTO.
Yeah.
And we want to understand whether that's by design or is it something that happened in the last 2 years. And my last question is regarding the co-working space. Understand your top 10 tenants have about 3.9% is co-working space, kind of tenants like WeWork and the working place. So I want to understand like, because some people see them as rivals rather than complementary.
Yeah.
So your thoughts behind that. And another question is like, why not do it yourself? Yeah, thanks.
Okay, first question, GTO hovering around 7% currently, about 7%. 4 to 15%, to some extent, not every property will be different. Some are designed because it restructured the rent during the difficult period of time. Yeah. But others are actually purely organic. They're on their own, they're performing just very well. Yeah. So I can even say 15% IMM is the top. We didn't do much on its own, it's gone up to 15%. Co-working space operator, we see both of them as complementary and rival, honestly speaking. But it has to be quite so the positions are quite different. So even the co-working space, the way they want to position themselves in the market will be quite different as well. So we work quite closely with TWP, who is actually our competitor, also our operator, right? But day one, when we decide that they want to operate for us, then there has to be a discussion on how the position will be differentiated. So that will not overeat each other's position. So we know very clear when there's a tenant walk in with a specific requirement, quite immediately we know which is suitable. Should it be a managed area or their own internal space? So the position could be quite clear day one. But then if it's the WeWork where we this entire 21 CQ, then we think it's a competition. Yeah. That's all.
The question is why
not do it ourselves?
Yeah, we are doing ourselves. Yeah.
Yeah.
It's just that we are getting
managed.
TWP in this case would be the one running the day-to-day, right? Instead of committing our own people to do the day-to-day. Yeah. And they also have their own network, they reach out, the way they market. And
Yeah, could I understand for the TWP arrangement? So they rented the space, or do they rent a space and they're operating on their own, and then you have a space that they are operating for you?
So they use CapitaSpring as example. They rent as a tenant with us at one floor. Then the another 2 floor, we say you help us to manage. We spend the capex on the fit out, but you help us to manage the space.
Okay, so I'm trying to understand, because say someone approached them, how would they know, like go to their own space or your space?
So earlier I answered the question. I said differentiation between the managed area space and their own rented space has to be quite clear on day one. Where you want to position the market, so that there will not be too much ambiguity when, let's say, a specific tenant comes for inquiry. But many a times actually it's true the other way around. When we go directly to the institution to market the space, and they have a list of requirements, of which sometimes it's about the swing space they need, quite easily we swing them to our own space. So quite a fair bit of inquiry actually coming from our own.
Okay.
I also would like to take this chance to just also to add on. Just now we talk about how much of managed space at CapitaSpring and the 6 Battery Road. So here at CapitaSpring is 2 floors of managed space, and at 6 Battery Road is 3 floors.
Sorry, I missed 3 floors.
Okay. Oh, Simon.
Yeah.
Okay.
Hi, Simon from DBS. Thanks for the presentation. Just 2 questions. First one I wanted to ask is, given where interest rates are today, I'm just wondering, do you see, in terms of balancing between encumbered and unencumbered assets, do you see that securitizing, either getting secured debt or perhaps doing more like your RCS trust bonds, would that be a viable solution today to addressing or managing your cost of funding? That's the first one. The second question I had is with regards to the office rentals. Is there currently, are you able to share if there's a clause providing for inflation? And do you see a need to adjust those clauses for the current context to allow you to recover or increase your rent?
Okay. First question, maybe I take the second question first. Currently, we don't have such inflation index. It's not a common practice in Singapore. It's very, very common overseas where it's indexed to certain kind of inflation index. It should be CPI, it could be RPI, it could be anything else. Singapore market doesn't really practice that. So our TA structure is such that it's all negotiated upfront. It cut both ways. Traditionally, you look at yesterday we're just looking, last night you just heard the news from Fed, right? It's like a 4-decade kind of interest rate. So historically, interest rates have been very benign. So if you want to have an inflation index, it cuts both ways. It can also hurt you. That means you are forced, not being able to adjust the rate when the demand is so strong. But inflation is still relatively benign circumstances. Whether we'll move into that, we do not have a clear position on that at the moment. I don't think that we want to do it. I don't think we have that inclination at the moment. Yeah.
And the question on secured debt.
Yeah, because the question, generally we don't find that significant difference between secured versus unsecured. And I would say in terms of the credit profile, I think that's where the difference is. We are rated A. So that itself is a very good rating for us to access the banks or the bond market without having to secure our property portfolio.
So meaning, just to clarify, there's not much savings you see between secured and unsecured debt. Therefore,
in fact, unsecured is generally lower than secured. based
Because you
on,
got the halo effect from a rated vehicle
Mm,
than
yes.
a single asset exposure.
I see. So there's no need currently.
Yeah.
Then how would you address the current outstanding for the RCS trust?
the
Do you intend to refi into bonds? Say,
the intention is that as and when the RCS debt due comes up for refinancing, we would raise debt at CICT level to pare it down.
all right.
And remove the security over time.
Okay, thank you.
Thank you. I think given time, this last question from the webinar. The question from Steve is, did CICT retain any cash in first half 2022? And do we have any retained cash, they put in bracket tax exempt, from previous years that are available for distribution? So two questions. One is whether we retain any cash in first half, and then whether we have any retained cash from previous years that are available for distribution.
We do have a very small amount of retained cash, largely coming from dividend income from the listed investments in the two REITs that we are holding, very small. And for previous year, I would say I do not believe that there's significant cash that we're holding back. Because what we hold is generally for working capital. There are small capex that we fund.
Oh. Okay.
Mostly overseas assets. Yeah.
Okay, we'll have last question from the audience here.
Sorry, I just want to understand the Xavier from Morningstar here. So I just want to understand the leasing market and office leasing market in Singapore a bit better. So I saw that your number of leases signed has dropped about 60% from last quarter to this quarter.
Yeah.
So just trying to understand why is the leasing momentum so slow, and is there something with about the spec or location of, say, Capital Towers that new occupiers are being kind of like put off?
Yeah. Well, okay, look at our overall, there's some big space backfill we've already done already. So I think more or less our portfolio occupancy is creeping up, except for Capital Tower, we are looking at it. So generally, they are also to some extent linked to the available space we have. But there are also new supply coming into the market. The GoCo Midtown Towers also coming in. So there will be a little bit more competition, I would say. But by and large, I would say the inquiry is not any worse off from a pace perspective. It's just that we don't have a lot of stock left as well for viewing.
Yeah. And then for the last one on the retail rental reversion, I think you have a side note that says that excluding the retail component of Raffles City, rental reversion would have been a positive 1.1%. So, I mean, given that Raffles City is going through a rejuvenation, I'm just curious, why is it dragging down the rental reversion number?
So it's because I think that one would be very misleading if you include, because Raffles City used to be single let, right? A single sort of anchored by Robinson. Now we are going to multi-let, and some of them we are bringing tenants that are used to be outside, they're going into that space. So kind of difficult to really measure that overall reversion, which is why we specifically strip them up for comparison purpose. But just to give a sense, if they were to go in, what kind of rent they're paying, where they are, which is what we're trying to do. That's all. Yeah.
Sorry, is that what the note is saying? Because the note seems to be suggesting that the Raffles City component is the one that is dragging down, but the way you are describing it sounds like the opposite.
Raffles City under excluding component rejuvenation for rental reversion will have been. Yeah, because there are movement within Raffles City. I'm talking about the movement within Raffles City. So Raffles City as a stock, actually the number can be quite misleading because the Robinson space represents about 25% of overall NLA. Right? So within there will be tenant that so we're cutting up spaces. We're cutting up spaces with the common corridor. So within there'll be tenants that used to be within Robinson. And there are also some tenants that within Robinson will bring them out into our own space. So it's very confusing from a reversion number perspective. Then there are some tenants we move from level 1 to level 2. There will be a bit of timing difference. Which is why we thought that space should be taken out completely. But the number is not a full representation. We will be more clear once I think it's stabilized. While we are trying to ramp up the leasing at the same time, we're also trying to, because there are some tenants who still want to stay on. Question is whether we want to put them in the right location, or same location, or other location, or other floors. So that reconfiguration will create a bit of distortion in the numbers.
Okay, thank you so much.
Thank you. So I think we've come to the end of our briefing and the Q&A session. Thank you very much, everyone, for joining us here and also online. For those online, noted there are a lot more questions submitted, some already addressed by the audience questions here, and the rest we'll get back to you separately. Thank you very much.
Yeah, thanks a lot.
Have a good day.
Cheers.